In this video, we're going to go over how to claim the Child and Dependent Care Tax Credit. So what we're going to go over in this video, we're going to discuss a little bit about the tax credit itself. We're going to talk about the credit amount and kind of the range of what you can calculate, the eligibility criteria, how taxpayers can claim the tax credit, and then we're going to actually walk through the tax form that's involved. So about the Child and Dependent Care Tax Credit, the intent of the tax credit is to help families with parents who work or who are actively seeking work to offset the costs of child and dependent care. We'll talk a little bit about what that qualifying child and dependent care is. So just understand that it doesn't necessarily have to be a child. It can be a dependent who's not your child. It is a non-refundable tax credit, so it cannot reduce your tax bill below zero. And there are certain situations where you may need to see whether or not this gets bumped by other non-refundable tax credits in order of precedence. So we'll talk about that when we go through the tax form itself. So the credit amount is basically it's a sliding percentage of the child or dependent care expenses based upon income. So that range is actually on the tax form. We'll look at it in a moment, but it goes from 20% to 35% of qualified care expenses up to either $3,000 for one dependent or $6,000 for two or more dependents. At three or more, you don't get any additional credit amount. So when you do the math, if you wanted to, if you were qualified or if you were eligible for the maximum credit, that would be $6,000 times 35% or $2,100. So the eligibility criteria, first, you must have paid the expenses for a qualified individual. And that can be a dependent qualifying child who was under the age of 13 when the care was provided. Once your child turns age 13 or older, they're no longer eligible for that criteria. If your spouse was either physically or mentally incapable of self-care and lived with you for more than half of the year, or if there was an individual who is physically or mentally incapable of self-care, lived with you for more than half of the year, and then met additional criteria, which was either you claimed them as a dependent or they could have been eligible to be your dependent, except for the fact that he or she received gross income of $4,700 or more during the year, or they filed a joint tax return, or you or your spouse could have been claimed as a dependent on another taxpayer's tax return. So broad brush, you're talking about a qualifying child that's your dependent, your spouse, or someone who is a relative that either was your dependent or otherwise would have been eligible to be your dependent, except for some outliers that made them not your dependent for tax purposes. So most likely scenario would be elder care, caring for an aging parent, or maybe grandparent, something like that. You have to identify all the persons or organizations that provide care for your child or dependent. Specifically, you have to report certain information about the care provider, their name, their address, their taxpayer ID number, which can either be their social security number or the employer ID number for the organization, like a child care facility. The care provider cannot be your spouse. It cannot be a parent of your qualifying individual. So if you're having someone care for your spouse, it can't be his or her mother or father. It can't be, so if the qualifying individual is your child and under the age of 13, the parent, even if you're not married, cannot be a care provider. The child who is under the age of 19, so you know you can't have your child babysitting your kids, and then uh, determine that that person now qualifies for the care credit. And it can't be a dependent that you or your spouse can claim on your tax return. So a likely scenario might be your child who's over the age of 19, but you're still claiming him or her as a dependent on your tax return because they're also in college. So to claim the Child Independent Care Tax Credit, you would complete IRS Form 2441. That's the Child Independent Care Expenses Tax Form. And then once you complete the calculation, you would then report it on Schedule 3, line 2 of your tax return. So now we're going to move on to the form. So a couple of things. Let's take a look at this form. This is the most recent version of IRS Form 2441, from 2023 tax year. At the time of this recording, the 2024 version hasn't come out yet, but the form really doesn't change much in substance from year over year. So other than annual adjustments for inflation, the mechanics of this form are very similar. There are 3 parts to this form. We're going to complete parts 1 and 2. You don't necessarily have to complete part 3 unless you received dependent care benefits from your employer, and that would be reported on your Form W-2. So if you didn't actually receive benefits from your employer, you don't need to complete part 3. So there is a part down here below. Basically, this is kind of summarizing all of this information from part 3, and then you take this amount and then you put it on line 3 of this form up here. So we don't necessarily have to do that from the bottom of here. We'll just go through and start at the top of the form. So we've got our taxpayer, John Doe. He's married filing jointly. We don't see that on the top of this form. If he's married filing separately, then you can't claim this tax credit unless you meet certain requirements. They're in the form instructions. We also discuss them in our updated article, and I'll put links in the show notes to it. But if you want to follow along in the article, you can go to teachmepersonalfinance.com, type in IRS Form 2441, and that article will appear. But you can check this if you meet those requirements. If you or your spouse was a student or was disabled and you're entering deemed income of either $250 or $500 a month based on certain income rules in the instructions, you would check this box. Now that we start part 1, you'll see the line 1 has up to 3 information fields for 3 different care providers or care persons. If you have additional, you would need to check this box, and then there are additional instructions. In this case, we only have one, Acme Child Care. We've put in the address. You must enter either an employer ID number, which applies to this case, or a 9-digit social security number. The IRS will not allow you to take this credit without that key piece of information. And then in column D, if the person was your household employee during the tax year and you select yes, you may need to complete Schedule H for household employee reporting. In this case, no. This is clearly an organization, and then we paid $6,000 in total expenses. And then You can also walk through this. It says if you didn't receive dependent care benefits from your employer, you only need to complete part 2. If you did, you would complete part 3 before you come back to part 2. So in part 2, we're going to list all the information for our qualifying dependent. If you have more than 3 qualifying persons, you can check this box, and basically it would tell you to enter additional information. So we've got Elizabeth Doe. Column B is the social security number. She happens to be under the age of 12, but if she was over age 12 and disabled, you would check the box in column C. And then we put down $6,000 of qualified expenses. So we had everything up in column 2, but these instructions for line 3 say don't enter more than $3,000 for one qualifying person. And again, if we go back, that's the most that you can put in. So that's what we put here. Now, if we had a second qualifying person, then we could claim the full $6,000. But again, you wouldn't put more than $6,000 here. So realistically, trying to create additional documentation for more than $6,000 of qualified expenses is, in my opinion, probably would be a fruitless exercise. That's already the cap of the credit calculation. So you don't need to do additional work to put additional expenses in here that won't count towards your tax credit. So in line 4, you're going to enter your earned income. According to the instructions, earned income includes the amount from your Form 1040 line 1Z, which is like your W-2 income, anything from that kind of earning arrangement, minus any foreign earned income that you might have reported on IRS Form 2555, or certain amounts that were reported on Schedule SE, certain amounts that were reported on Schedule C, and then non-taxable combat pay. So you would back all of that out to enter your earned income. And again, if you need more detail on the specifics, we do cover that in our article. So if you're married filing jointly, you would enter the earned income from your spouse. All other taxpayers just enter the amount from line 4. So we're going to put 0 in here. And then it doesn't really matter. We're going to take the smallest of these. And what this is trying to say is you can claim the maximum of your expenses or your earned income. So if your earned income for the year was only $2,000, then you wouldn't be able to claim the full $3,000. You would only be able to claim $2,000 of expenses. So that's how that would look. But we don't have to worry about that. So now in line 7, we're going to take the amount from your Form 1040, line 11. This is your adjusted gross income. And then we're going to apply the amount based on this, and this is the sliding scale that I was referring to. So any income from 0 to 15,000, which is not that much, qualifies for the full 35%. And then you can see these income ranges down here. If your income is over $43,000 and there is no AGI limit, like ceiling, so probably most taxpayers are going to put 20%, unless you're, in between jobs or, have a low taxable or adjusted gross income year for some reason. And now we're just going to do the math here. So we multiply the 20% by the 3,000. We get $600 of expenses. So in line 9B, if you paid prior year expenses in the current tax year, then you would need to complete an additional worksheet that is in the form instructions. So you would possibly get a little bit of an additional credit here. In this case, no, we didn't post or we didn't, pay prior year expenses. So we're just looking at the $600 here. There is a credit limit worksheet in the instructions. And so this is the tax liability limit. So you can't claim a tax here that exceeds your total tax bill. So if you had a $500 tax bill, you could only claim $500 of this tax credit. So you do the credit limit worksheet in the instructions, which kind of go over right here the tax credits that supersede this, and there are only two. So the foreign tax credit right here that it supersedes all other non-refundable tax credits, and then this form, IRS Form 8978, that's the partner's additional reporting tax. So basically, if you're not a partner in a partnership, you don't really need to worry about this. If you don't have any foreign tax income and you're not claiming the foreign tax credit, then pretty much this is going to flow through to right here. So you would take this, you would enter it on Schedule 3, line 2, and then that will flow through onto your tax return to reduce your tax bill. So that's all we have for this tax form. As I mentioned, we'll put links in the show notes to the articles and the videos that we created about forms and schedules that were mentioned here. If you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, or if there's another topic that you would like to see covered in an upcoming video, please hit me up in the comment section. Thank you very much and have a great day.